All right, so chapter 7, okay? Fraud, internal control, and cash. So not quite as heavy as we were in the inventory. On page 308, they start off by talking first about fraud. It's pretty simple about fraud. Fraud is bad. You get in trouble. Don't do it. Any questions? It's pretty much all there is you need to know about fraud, right? Now they talk about fraud as a dishonest act by employees, and the whole purpose of internal control, which they do go into some detail about, is to not only prevent fraud. I mean, clearly that's part of it, but it's also internal controls help prevent errors, honest errors, and so it makes the financial statements more accurate. But a lot of it has to do with trying to maintain control over our assets. And so they talk about what internal control is on 309. You should be familiar with that. It's a process of providing what they call reasonable assurance regarding the achievement of objectives related to operations. Basically, when they say reasonable assurance, they want to make sure that we're making the inventory, we're making all the assets safe, but we want to do it within what we call cost benefit. It's cost effective. So you want to make sure that the cost of doing the internal control doesn't exceed the benefit that you get from it. And we'll talk, petty cash is a good example. We'll talk about that later on. But petty cash, you don't put a big amount of petty cash in there, maybe $100, because that way, if you lose $100, it's not that big a deal. Somebody steals it. And it saves you from having to keep as much detail control. If you had a petty cash box that had $10,000 in it, spend a lot more time and worry a lot more about it. So the idea is to try to keep the cost down. What are the purposes of internal control? Again, they list some on 309. What do you need in order to be effective? 5 primary components. You need to have what they call a control environment. That just means the company and the managers of the company need to be focused on really being serious about letting people know to keep control and do things right. You have to have that values or that ethical approach to it. A risk assessment, you want to try to make sure that you know what are your risks and have the controls match to the risks that are appropriate. Different companies have different risks. You want to create control activities, and that's basically just the processes and procedures you have to make sure that things are being done properly. So it's the actions and tasks that are done to make sure that everything is being done in a proper way. Information and communication, you want to make sure that you're gathering the information and then communicating it with everybody in the organization that needs it. So maybe that's a review process and then an approval process, or it's just letting people know something's going on, they need to have the information to make a decision. So that's one of the roles of a control process as well. And then finally, the big one is the monitoring. That just means it doesn't do any good to have control activities and procedures in place if you aren't checking them. So you need to make sure that there's a checking that's going on periodically to make sure that everything's being done properly and people are following through. They talk about some 6 principles of control activities over on page 310. The establishment of responsibility, that's probably the most important. Every activity that's out there, you need to know who's responsible in the organization for it. Because otherwise, then either it doesn't get done or if something's wrong, then or something happens, then you don't know who to go to find out what happened. So make sure that everybody knows who's responsible for what activities. That's very important. Usually that means having certain people that have access to areas of that contain assets or items that need to be limited to be protected, and maybe have approval processes. You only have certain people who can approve things. So that's what that means in terms of responsibility. They talk about segregation of duties in the top of 311. That's really important, and the way I learned it, they don't talk about it this way, but I want to put it down. You really want to have, for good segregation of duties, you want to have 3 things separated. Okay, segregation, can't even spell. Segregation of duties. So these are the 3 things you want to have separate, okay? The first thing you want to have separate is the approval process. So that goes back to that accountability and responsibilities, but you want to make sure that whoever has the ability to approve or has authority over assets is separate from whoever is doing the record keeping. And you also want to make sure that you have the custody or control of an asset separated. So the best separation of duty comes from having 3 different people doing those activities. Because then what happens is it takes 3 people to collude or have collusion where they have to get together and agree to do something wrong for a fraud to occur. So separation of duties reduces the chance of fraud. It also increases the chance that mistakes will get caught because you have people reviewing each other. So the idea would be in a business, you wouldn't want to have, for example, the bookkeeper being able to write the checks and sign them, and then record the check, and then also go to the bank and have access to the bank account, have control, be able to put money in or out, sign for the bank account. Because then the bookkeeper could basically do anything they wanted, and you wouldn't know if you were the owner, right? So what you do is you'd split that up. So maybe you'd say the bookkeeper can go through and prepare the checks, because that's what bookkeepers do, but they bring them to the owner, who then signs it and gives the authority. And then what happens is, then when the checks come in, you don't have the bookkeeper do the bank reconciliation, which we'll talk about as a control. You have somebody else go and be the bank, do the checkbook reconciliation. And then the custody, who can actually have control over the bank, like change check signers and everything, would be somebody other than the bookkeeper. I guess if it's the owner, you can have the owner have the approval in custody, because if the owner's stealing from themselves, that would be kind of counterproductive. But the idea is you split those three things up. Okay? So the book talks about the different responsibilities for people, that's the authority, and the record keeping. What they don't talk that much about is the custody. But when I was taking auditing, this was drilled into us. These are the three things you always want to have segregated in a good segregation of duties. They talk about segregation-related activities. Again, making sure that you don't have one person doing everything in a task, maybe having it split between two people also helps catch errors. They talk about segregation of record keeping from physical custody. That is this section right here. That's over in 312. So you want to have the person who's keeping track of something different, who's keeping records of it, because the record keeping is supposed to be keeping an idea of what's happening. The custody is supposed to be keeping the asset, and periodically you compare the asset and the record keeping. That's what we do when we do the inventory, right? We keep the records for the perpetual inventory, and then periodically we go out and we actually count the inventory to see if it's there, and we compare it. They talk about the documentation process in 312. That's important. Basically means you want to keep everything written down so you have an audit trail to go back and look at. They talk about having pre-numbered documents so that people know if there's a break in a sequence for like a purchase order or a check, you can find out what happened to it. You don't want people to go in and start taking checks and keeping them and then writing them and you not knowing that they're missing. So if they're in a sequence and there's a break in the sequence, you find out what happened to it. So that's a good internal control. Physical controls, they talk on the bottom of 313. That just means that you keep things locked up. If you have something that's valuable, you keep it under lock and key. You keep access to your computer records with good internal control, like a good password or a firewall to protect your computer. So you keep things where unauthorized people can't get to them. That's what that means with physical controls. Independent verification over on page 314. That just means that whole idea that periodically we go through and we check to see if what the records say are proper and match to some subsidiary or some external item like the inventory. So somebody's going to go through and check it. When we were auditors, we would always do an independent verification of inventory by going out and counting the inventory, as I said in the last chapter, and comparing it with what was on the accounting records. We also would check the bank records. At the end of the year, we would say, somebody said they had so much money in the bank, we would send a letter to the bank and say, can you confirm what the amount of the money is? And we would compare the cash that was in that account with what they had in the records to see if it was the same. We would compare it. We do an independent verification. Many companies have internal control, internal audit departments, that's what they do. They go around and they check internally to make sure that what people are recording agrees with what's actually going on somewhere else in another area. So anything that you find it's a variance, of course, you want to follow up on, and you're monitoring it to see if there's variance. If there is, you want to find out what caused that variance. On the bottom of 313, they talk a little bit about ways you can control the human resource side. That means when you hire people, you have the right people in the right place that are doing it. So the first thing they talk about is bonding, which is if you have people handling cash, you basically buy a bond, which is an insurance that you pay to a bonding agency that says if they steal or lose the money, then the bonding agency will cover you. So it's insurance against fraud is what that is. Number two, rotate employee duties and require employees to take vacations. This is important because if somebody is going through and trying to circumvent and have a fraud, they need to be there to make sure it doesn't fall apart. So by requiring people to take a vacation for at least a week or two, it's harder for the fraud to keep going and somebody else might find out about it. So what happens is that's a way, again, of internal control. Rotation of duties is a good idea. Not only does having two people knowing how to do it and having them check each other help you if one's sick or leaves, you have somebody else who can do the work, but also by having somebody else reviewing it and checking it, if one person is doing it and they're trying to hide something, when the other person does it, they'll probably find the mistake or find the error. So that's a good internal control. And then the last one is just make sure you check up on your people. Do background checks. Actually find out if they work where they said. Make sure if they have any sort of a problem that you follow, find out what that is. So just avoid the problem in the very beginning. There are some limitations they talk about over on page 317. Again, that's where we have the reasonable assurance that the cost of having control procedures shouldn't exceed their expected benefits. That can be a problem in a small business because a small business doesn't always have the ability to have enough people to split these. So you often do find in a small business maybe one person, a bookkeeper, somebody doing 2 or even 3 of these. That's not good control. The way you break that up is maybe bring the owner in and have the owner be more involved. The idea is, again, the owner is going to have more of an idea of what's happening and care more about what's taking place. And if somebody knows the owner's involved, they're probably going to be less likely to try to do a fraud. The other thing you have to watch out for is collusion, and that's just where you have more than one person trying to get together and agree to work together to perpetrate a fraud. So again, as you have more people involved, that goes down because the risk is that people don't want to do that, so somebody will say that's not right and say something, or if you have too many people doing things, then things get screwed up and eventually somebody talks or somebody breaks something and you find out about the fraud. So don't do it. Fraud bad. On page 317 they talk a little bit about cash. That's really what we're going to focus on now. The internal controls for cash are the most important because cash is the best asset, the worst asset, it's the easiest asset to steal because, it's small, it's pretty easy to transfer, and you can very quickly convert it into something else. So cash frauds tend to be the ones that are hardest to find and the most likely for people to want to perpetrate. Cash is something people like, so if they can get it, they might figure out how to do that. So the ways you go through and to control that is, first off, you control it when it's coming in, cash receipts. So you always go through, and if you have somebody opening the mail, if you receive checks and cash, or cash coming in, something like that, for the checks, you have 2 people opening the mail, and you always write down how much they received, okay? They're not the ones who are the record keepers. You have somebody else that's doing it other than the bookkeeper, because you want to make sure that it's getting recorded and 2 people watching each other. Less likely somebody's going to slip some cash away from an envelope when nobody's looking. You also go through, and if you have cash, you guys have probably, some of you worked in retail, you go through and you have to count the cash drawers. You always have 2 people counting, or have a manager counting, something like that. Again, that's a control mechanism. See, that's about cash. On mail receipts, we talked about that, having 2 people open the mail. Cash disbursements, there you just want to make sure somebody's not paying themselves or creating, a very common fraud is somebody to create false documents and then pay the false documents. So you want to go through and make sure that there's an approval process, that somebody is looking at the checks, and that they have all the documentation. There's an actual invoice and everything that supports it. So you want to have somebody else who's preparing the records, somebody else doing the approval of that. And they have in the chapter, I actually like, they have a lot of really little examples of frauds that occurred for each one of these. And if you read through them, they're actually very entertaining. They're interesting to read, and they show you how the process that was, the control that was in place was either not there or circumvented. So it's a good little real world example of how you need to keep an eye on things. So those are actually pretty good. All right, so that gets us over to petty cash on 322. Now petty cash is real easy. The idea behind petty cash is this. You're going to have employees who are going to be buying stuff, okay? And you don't want them to have to buy it and then have to turn around and submit a purchase all the time, order everything. It's kind of a lot of work. Somebody's going to go out and buy something. You need to go buy some stamps because you're going to mail something. So somebody says, at lunch I'll go out and buy $10 worth of stamps. So you don't want them to have to come back and submit a purchase requisition and go through that process. It's a lot of work, and they won't buy the stamps if they aren't going to get their money back. So what you do is you create a petty cash. It's basically a small amount that you keep in a lockbox, and you give one person responsibility over that, and their job is to reimburse people when they come back with just the receipts. You don't have to have any pre-authorization or anything. The idea is that it's a small amount so that the worst case is if it gets stolen, you don't really care. Okay? But it also keeps people from having to go around and collect all their money at the end of a period. So what you do is this. First off, when you establish the petty cash, you go through and you're going to do it's kind of strange, you're going to take money out of cash and put it into petty cash. So they show this on page 322, where on March the 1st, we did a journal entry to create petty cash. So what we did was we went through and we created petty cash as a debit, and it's a separate account, and we set it up for $100. And then we just moved it out of cash. We wrote a check. So it's basically a transfer. And if you're putting this on a balance sheet, petty cash is added with cash as part of the cash line. And that's all you do. If you need to go through and increase it, you're going to do another entry, but we don't talk about it here. We assume your $100 is good. Then what happens is during the period, people are going through and they're buying stuff. Somebody says, oh, I'll go buy and I'll pay for the postage. I'll pick up some stamps. So they do that. They bring a receipt back. They give it to the person that's in the petty cash. That person gives them the money. They take the receipt. After they got the receipt, make sure it's right. They put it in the box. Nothing happens. Somebody else says, oh, yeah, we had to pay for some freight. I took something over and shipped it out. I just paid for it. Here's my invoice. You get the invoice, you give them their money, and then the invoice is sitting in there. So you go through, and at the end of each period, you want to keep track until you get to the end of the period, and then you need to go through and you need to reconcile the petty cash. Or if the petty cash is getting low because people are running out, you have to do that. So what you do is you go through, and this is on page 323, you're going to replenish the petty cash fund. So in this case, they said at March 15th we were getting a little low. So somebody said, well, we better get some more petty cash and fill it back up. So remember, all those invoices have been sitting in there. They haven't been recorded yet. They are expenses of the company. So we're going to go through and take those receipts out, and we're going to record what those costs are. So whoever it was that bought the postage for us, we say, oh, there's that receipt for that postage, and that person had spent $44, so we're going to record $44 as a debit for our postage. Somebody else had paid for the freight. They'd paid to have something shipped because we needed to send it out overnight or somewhere, and that was $38, so we go through and we put that in. So we showed that expense for the period. We had, what was the miscellaneous? Did they tell us what the miscellaneous was? I don't know. There's a bunch of other stuff, little things. Miscellaneous. Just miscellaneous. I hate miscellaneous, but all right. I am. So miscellaneous expense. Maybe we don't know what that is, but there's an invoice and somebody spilled coffee all over it. And we can't quite read what it is, but it's $5, and we don't want to spend 2 hours of our time trying to find $5. So we just put in miscellaneous. I like that. It's coffee stain. Now here's the thing. We want to go through and we want to replenish the petty cash fund, okay? And this is what always confused me when I was learning about this. You think, well, then we need to do a journal entry to petty cash, right? And the answer is no. We're going to do an entry to cash. We're going to add all these up, and it's $87. And it turns out that we must have had $13 in our petty cash box because we need $87 to get it back to 100. The amount that we're going to take out of cash, we're writing a check, right, to cash? We're basically writing a check, and that's the amount we need to return the petty cash back to the 100. So the petty cash never changed. It always stayed 100. We just needed to take it out of cash to put it back in there. So you don't do an entry to petty cash when you replenish it. That always messed me up. I always wanted to do something with petty cash. Don't do that. Now that's assuming that your invoices all add up and the amount that you need is exactly what the invoices are. Does that ever work? No. Probably not. Somebody didn't turn in an invoice. You gave somebody miscounted. They were in a hurry. They gave back too much or too little. So what happens is another scenario where you go through and they give this over on page 324. You go through, and when you count it, you actually have $12 cash in the box. In the box, petty cash box. And you need to have how much? You need to have 100. You want to bring it back up to the 100. So you need $88. You're going to write cash for $88 because that's what you need. But all these only add up to 87. So you're going to have to reach in your pocket if you're the custodian and make up the difference, right? No. What you're going to do is you're going to go through and you're going to put it into whatever side you need. In this case, it's $1. It's called cash over or short. If it was the other way, maybe you had too much money because you miscounted and somebody didn't find out that you didn't give them enough. You might have it on this side. It could be a credit. But basically, it's what you need to balance after you've added up all your invoices that you had in there and you figured out what you needed to replenish the petty cash back to the original amount. So if that doesn't balance out by itself, the difference goes into cash over or short. And as long as it's a small amount, it's not worth time to go through and find out where it's at. That gets into that cost benefit. Okay? So that's petty cash in a nutshell. the big area that we talk about with control in the cash area, of course, though, is using a bank. Big amounts, petty cash, $100 in a box, that's fine. You wouldn't want to have $100,000 that you need to run your business sitting in a box or on your mattress. You just wouldn't want that. So you're going to put it in a bank because that's where it's going to have the most control. It's going to be safer and it's harder for people to get to. And then you're going to control the access to that by who can get to the bank, who can write checks, that sort of thing. So most companies use probably several bank accounts for different sources. But the key is that if you have a bank account, you still need to go through and check it periodically to make sure that the amount that you have in the bank agrees with what your book records are. That's part of that control, part of that monitoring process. And so what happens is you go through and you're going to get a bank statement. Now again, you typically don't want your bookkeeper to be doing the bank reconciliation because your bookkeeper was doing all the debits and credits. It's a good idea if you can have somebody else do the bank reconciliation, because it's a way to check to make sure that the records are proper. In most cases, guess who does the bank reconciliation? The bookkeeper. So it's better control if you have somebody else do it, but the reality is many times the bookkeeper does it because nobody else knows how to do it, and that's the role of the bookkeeper. But it's a good idea if you can have somebody else do the reconciliation, and then when they've proven that the bank statement is an agreement, then they can give it to the bank, or the bookkeeper to do the entries that are necessary. So how do you do it? Well, they talk through several pages, but let's just go over to the bottom of page 330, and let's walk through this bank reconciliation. Now, how many of you actually still reconcile your bank accounts? I usually don't see very many hands go up. In this day and age, when we can call up on the phone what our balance is, most of us don't do that. We just see how much we need, right? But it's a good control mechanism to go through to make sure, because you want to figure out not only that your balances are proper, that you haven't recorded anything incorrectly, but also you're going to use this to figure out what needs to be recorded. Because sometimes what will happen is you find things the bank knows about that you don't know, and you need to journal entries. But the point is, I was going to say, if you've done your bank reconciliation on your own, oftentimes what they'll do is they'll start with the book or the balance in the bank, and then if you looked at the old forms on the back of your statement, if you ever did do a bank reconciliation, it would go from the bank balance to your checkbook balance, and that was a reconciliation. Well, that's not the way you do it in the accounting. You're going to go, we're going to reconcile the check balance, the book balance, and we're going to reconcile the bank balance, but we're going to take them down to what we call the adjusted cash balance, which is really what the cash balance should be. So the way we set that up is we do this. We go over, I'm going to do it a little different than the format because I like to do them side by side. And I'm going to start with the balance per bank, okay? So the cash balance per bank statement. Just not good at whiteboard management. Cash balance per bank statement. And so you look on your statement and you see the bank says that you have $15,907.45. But there are some things that you know have happened that the bank doesn't know about. For example, you know that you wrote some checks, but those checks haven't cleared because you're going through the bank statement and you're seeing that they haven't cleared. You also know you made some deposits and you don't see them listed on here. And you realize, oh, I did that deposit, the date that was on this bank statement was the day before I did the deposit. Because of course it took you a few days after you got this when you got it in the mail. So you're going to have to go through and make adjustments for that. So the first thing we're going to go through and do is we're going to add the deposits that were in transit. In other words, deposits that we have made that we know about that weren't on the bank statement at this date. So we go through and we add those. In this case, this was $2,201.40. So 18,108.85. Then we also had some outstanding checks. And these are checks that we had written that we know, we can see them in the checkbook, that they were written, but the bank hasn't got them yet. The other person we wrote them to hasn't yet deposited them, or they haven't cleared through the system. And the way we find that is we go and we look at the list of our checks, because we have a sequence, and we see where the sequence is broken on the bank statement. So we go through and we see, oh look, there's a break at check 453. Oh, it's not in it. We have 452 and we have 454 in the bank statement. Where's 453? We go over to the checkbook and we see, oh, that's that check we wrote for that $3,000 item. So we use that to go through and compare from our checkbook, our check register, what our items are. So we go through, and it's getting late, so I'm going to cheat. And I'm going to say our total outstanding checks, there were 3 of them. That was $5,904. Okay. And again, you would list those out. And then, so we're going to subtract that because the bank didn't know about that. Okay. So what we have now is our adjusted balance. Per bank. And we subtract that down, that's $12,204.85. So that's what we think we should have on the bank side, okay? Now we're going to go over, we're going to say, okay, what do we have in our accounting records? So we're going to take our cash balance per books. And what we show in our general ledger is we show $11,589.45. Okay? So we say, okay, well, then how come that's so much different? How come we got this different number? So we go, well, I don't know. Wonder what's going on. So we start looking at the bank statement and seeing, what are they doing here? And they go, oh, look at the bank statement. There's something we didn't know about. They went through, remember that loan that we had that somebody owed us? We told them to pay the bank when it was due. They did. The bank collected it. We didn't know that happened. So we go through and we say, okay, we're going to add, in this case, the collection of note payable. It's note receivable, I should say, right? Because we owed it. Somebody owed it to us. So the collection of note receivable, okay, which was $1,000, plus interest, because the person owed us interest, $50. We didn't know about that either because we didn't know how much interest was. And then the bank charged us a fee, right? So fee, $15, because the bank doesn't do anything for free, right? Mm-hmm. So we add the 1,000, we add the 50, we subtract the 15, and that was $1,035. So that was money that was put into our bank account we didn't know about. So we're going to have to put that in. We also went through and we found an error. We went through and we said, oh look, we were trying to reconcile this, we were off by a number. We were off by $36. We kept looking and we realized, hey, check 443, we wrote it in wrong. We transposed. Usually if it's divisible by 9, the amount we're off, it's probably a transposition. So what we did was, they tell us we went through and, did they tell us what we did? Yeah, it should have been $1,262. We wrote it down for $1,226. So we were wrong. And so the difference between that is $36. So we have an error. And it's on our side. Our book, error in recording, check. We put it in the wrong amount. So now we're going to go through, and in this particular case, that was in our error. The error could be on both sides. It could either be an addition or subtraction. This one happened to be in our favor. So that works out to be $1,071 that we need to add back. We didn't know about those items. What else do we see on that bank statement? Well, we go through and we start looking and say, oh look, we got a check from Joe. Turns out Joe had a bad check. He didn't have money in his bank, and they sent Joe's check back. So they're going to hit us with that amount. We put it in as a deposit, so we thought it was included in our balance, but it turns out Joe's bank said no, he's no good for it, so they sent it back, and so the bank took it out of our account. So we have a NSF check, insufficient funds check. And so that's $425.60. That's going to become a receivable when we record this later on because Joe owes us the money still. We're going to forget about it. We also have those bank service fees. Maybe it was because of the NSF check, or maybe that's just the bank fee and we didn't know what it was because it varies every month, but we didn't know what it was until we got the bank statement. So that's $30. So we take all those and we come over here, and that's $455 of expenses that we didn't know about. So now if I go through and I add my balance that I thought I knew, I add in what I didn't know that had been collected, then I'm going to record, and then I take out what I didn't know had been subtracted. Hopefully if I do that, I have 12,204.85, and I do, I go, oh look, that's my adjusted balance. Per book. And if these two agree, then what I've done is I've reconciled my bank account. So I can show that the changes that were from the cash balance, I understand what those were. The changes from my book balance, I understand what those are. And I actually need to now go through and do journal entries to record these, because these didn't happen. I'm not going to walk you through those, but you actually have to go through and record the cash coming in for this receivable. And you have to record the receivable going away and the interest and the fee. You have to show an adjustment for the recording of the check, so you have to go back to the accounts that were originally recorded and correct them to make sure they're proper. I have to go through and show an expense for the service fees. I have to go back and show my NSF fund from Joe that he has an account receivable with me now. So I actually do journal entries to record all these, and when I get done doing that, the journal entry adjustments to cash are going to get me down to my balance right here. So this becomes my new balance on my balance sheet at the end of my period for cash. Okay? So that's the bank reconciliation. You guys will do one of those on the test.
What about the journal entries?
Not so sure. Depends on how much time you have. But definitely the bank reconciliation. They talk a little bit about cash equivalents over on page 333. That just means there are some investments that are so short they actually get added with cash. U.S. Treasury bills, money market accounts, and a commercial paper. We'll talk more about those in 202, so don't worry about those right now. Cash is always listed as the very first asset, current asset, because it's the most liquid thing we have. And they talk about what gets added into cash. It's going to be any currency, paper, coins you have, so your cash boxes if you're a retail company, your cash drawers, all that gets added into cash. Any money orders you have, any checks you have that haven't been deposited, obviously the amount that you have in your bank accounts. So when you see a line that says cash on a balance sheet, usually if you look at the detail, there's several different sources for that. You know, we just wouldn't want to list them all out because it'd make the balance sheet too long. But it's all the same thing. It's money that you can use right now to pay bills.
You add petty cash too, right?
You would add petty cash into your cash on the balance sheet as well. Okay. Any other questions about cash or internal controls? All right. That's cash.